Want to get a quick check on the markets. Joining us this morning is Tom Atterbury. He's portfolio manager at First Pacific Advisors and Morningstar's 2008 Fixed Income Fund Manager of the Year. And from the CME, Bob Iacchino, the chief market strategist at lotusbrokerage.com. Guys, good morning to both of you. Tom, begin with you. I was interested reading your notes. Despite being a bond portfolio manager, you're not a big fan of where we are right now.
No, I'm not a fan at all. And I think one of the key reasons, if you look at the situation, you've had a government entity, or other, whether it's the Federal Reserve or Treasury or others, inject themselves very heavily into the bond market, somewhere in the tune of maybe $1.5 trillion. We might have another $0.5 trillion from the Federal Reserve from QE2, interjecting themselves into prices, trying to drive interest rates to a certain level for activity. And I think when you do that at these very low levels, there's a tremendous amount of risk that you're undertaking. That's not a player who's in there to make a positive return.
So what is your strategy then, given that sort of, I guess, you'd call it a bleak outlook for now, right?
I would call it a bleak outlook. If you're a lender, it's probably, it's great if you're a borrower. Okay. I think you stay very short. Your maturity should be 5 years and in. Whether you want to look at a corporate, whether you want to look at a government agency, I don't think it makes any difference. Keep a very short maturity to you. You've got a tremendous amount of interest rate risk in the bonds of which you're purchasing, and you need to minimize that risk as best you can.
Is there a number that we could get on the second or third from the Fed that would ride what's disappointing and what's satisfactory?
Neither.
Really?
Well, if you figure, you just look as an example, okay, do you want to lend the government money for 5 years and earn 1.1%? Do you want to lend them money for 10 years and earn 2.5%? When if you look at inflation, it's typically been in a range of 2.5%, 3% for a long period of time. So you're willing to lend monies to somebody of which your real return is negative. So whether they want to do $200 billion or $300 or $500 billion, it just makes it worse. None of them are good. It's just, oh, this one's bad, that one's worse.
Right. Bob, does the same dynamic apply to equities heading into the Fed meeting?
It does in a way. I like what Tom said about the duration in the bond market, where with the equity markets, your risk is ultra short term. There's less risk ultra long term. It's a trader's market, ultra short term. The investor seems to be non-existent, but the medium term of the market, the somewhere from 2 to 5 year range, carries a lot of risk with it. I think there's been a lot of cases made over the last few days on your show, especially for the knowledge or the intelligent move of buying quality companies and waiting about 10 years, 15 years, and seeing where they're at, and you should do quite well.
Yeah, you obviously heard what Bill Miller said yesterday.
Exactly, and I thought that was a great conversation. But if you look on the short term, we're up a little over 7% in the S&P 500 over the year. We're up a little over 3% quarter to date, and we're up over 3% month to date. So you can wipe out that 3% in November, wipe out half the gains for the year, and if that doesn't illustrate the short-term volatility in the equities, I don't know what does.
Yeah. Tom, do you have a feel for the longer-term economic backdrop? We're getting some earnings that are coming in pretty solid overall. Getting some guidance that it could be worse, right?
If I look economically out over several years, I think you're still going to have a very, very sloppy economy. Your growth is going to be very suboptimal. You've got a tremendous amount of leverage in the system, whether it's the consumer, the household, that still is needing to repair their balance sheet and acts as if that's what they're doing. As you look at consumer borrowings continue to decline, you look at the banking system, and it still continues to struggle with the bad loans that it has. Yes, you see them, well, okay, my loan loss reserves have declined. But as we look at the housing situation, whether it's the foreclosures and the robo-signers, or whether it's the reps and warrants where they want them, someone wants them to buy back the mortgages, those we don't know the amount that they're going to have to spend.
Right.
So they probably don't know either. So that means they're going to tend to hold back more capital to cover that. And then, as I heard earlier on your program this morning, you've got regulators wanting more capital at the banks in order for them to be more secure. All that leads me to believe bank lending is going to tend to be at a subdued level. So I have both a lender and a borrower who are not enthusiastic about doing either task.
Business together.
Yes, about doing business together, which says, okay, my economy for an extended period of time is going to grow at a very reduced rate.
Yeah. Interesting. Tom, Bob, thanks for your time. Good to talk to both of you.
Thank you.